G'day Fools, I'm Scott Phillips, the Motley Fool's Chief Investment Officer here in Australia, and welcome to a brand new Motley Fool series. We keep rolling them out. This one is going to be called Stocks in Focus. This is a chance for us to talk to you about some of the stocks that we know you hold or are interested in. And we're starting off with the biggest one, the most widely held stock, the one that most people care about, search for, look for, and that is the granddaddy of them all, Commonwealth Bank of Australia, CBA. And the question we're going to ask our analyst, who I'll introduce in a minute, is can it really win from here? That's the tease. Stay around for the answer. Excuse me. First thing I'll say is we are here to provide you general advice, not personal advice. We can't tell you what you should do. Secondly, as I've said before in other videos, this is date stamped today. We're recording this on the 15th of July. If you're watching this in a couple of years, or 15th of July 2021, I should say, if you're watching this a couple of years later, assume that the information and advice, hopefully we've updated since then. This video will be good for a while. We will talk generally about the company, not specifically about right now, but keep that in mind. And lastly, as I say every time, we are long-term investors, so we're not doing short-term forecasts here. We're looking at the business and its long-term potential to be a market beater. And with that, let me introduce Ed Vesely. Ed is one of the Motley Fool's longer-term analysts and lead advisors on quite a few of our different services. Ed, g'day.
G'day, Scott. Good to be here.
Thank you, mate. Now, look, we wanted to start this series with CBA because it is the biggest of the big. It is the most widely held retail stock as far as I'm aware. It's the one that kind of we all look to, and is also considered, by the way, the highest quality of the banks. So you may disagree. We'll get to that in a minute. Mate, so we want to talk about CBA. I thought, who better to chat to about the Commonwealth Bank than Ed Vesely, our resident dividend expert, our resident income expert, because that, after all, is what many of the CBA shareholders hold the stock for. And I am going to ask you whether it really can win from here. But firstly, mate, how do you intro this? These are strange times. We know that. The last 18 months have been a really, really bizarre roller coaster ride for everybody in the economy, for employees, for businesses, for investors, and of course for our banks. Property prices were forecast by some people to plunge by up to 30%. Not unusually, those doom and gloom forecasts didn't come to pass, funnily enough. But CBA and other banks did have a lot of bad debt provisions they were making. Dividends were cut, partly out of their own good graces and partly because the regulator said they had to. They seem back now, and yet we are back in lockdown as we record this in New South Wales and Victoria. So, mate, there is so much happening in our banks, to some degree, are the bellwether of the economy. Let's start just by kind of giving me a summary of where CBA is right now. How would you describe CBA's last 12 or 18 months? How does it sit? How is it looking as a business right now?
Sure thing, Scott. Look, just you're right about. Look, it's a big bank, and it's certainly popular. There's a lot of members, shareholders, and just the general public looking it up just to see what the share price is. Just before I even start, there was a fantastic article in the AFR just a couple of months ago titled "Carol's Laughing All the Way to the Bank." She's one of those CBA employees who bought shares back in 1991, has never sold a share.
Oh, wow.
And has basically seen a gain of almost 2,000%. So it's got that history.
That's awesome.
As you say, where are we today? I actually, just prior to this video, of course, I did a bit of research and I looked up the financial results for 30th of June last year, and there's been an update since then. But I see that the net profit for the 20 financial year was down around 11%. That's the cash net profit, with the bulk of that I suppose the earnings coming from its retail banking arm, which is the classic deposits, credit cards, and mortgages, and so on. Now, since then, there's been there was an update back in May where the cash net profit came in at 2.4 billion, and that's quite significant because the increase in that is around 24%. Above the quarterly average for the first half. And so there's been some improvement. But as you say, there's so much going on in the economy, Scott. There's so much noise and there's so much, I guess, just variability and volatility just in the economy, and in a business as big as this. It's a market cap of 174 billion at around $97, $98. So it's big, and we certainly have to look at the macro in terms of how it's going to perform. This last quarter was really good, but I'm just a little bit hesitant about thinking, well, how long can this progress for? So I could go on about, there's lots more to talk about. Retail banking accounts for around 57% of the total. Business and private banking has also done, that's around a third of the business. And then you've got institutional banking, and then there's the New Zealand segment as well, which accounts for around 14%. So it is a bank. It's pretty much a lender. It takes deposits and it lends out money. So the business is fairly simple. it's also, I suppose, the simplicity of the business is improving somewhat because of the fact that they're moving out of funds management, or they've done that already, and they've announced recently too that they're selling their comm insurance business as well. That'll take some time and will probably happen by next year sometime in FY22. So we can deal with the Commonwealth Bank and just treat it as a lender. And yeah, look, it's been historically a very good payer of dividends. So there's a lot more to go into, but that's basically where we're starting at the moment. We've got last year was down. We're seeing a slight improvement in the last quarter, and we'll look forward to seeing what the annual results look like for when they come out in August.
Yeah, a couple of thoughts, mate. Firstly, I mean, the numbers are really messy right now, right? Because there are so many provisions and then provision write-backs. Now, for those of the uninitiated, any company, but particularly banks, are obliged to effectively record liabilities or effectively the risk of loss or a debt to be written off should the bank believe that its borrowers aren't going to pay back. And so during the depths of the COVID recession, April, May, June, July, August, September last year, plenty of banks took big provisions by saying, look, we know people are going to be out of work. We know people are going to struggle for money. They're probably going to default on their loans. We have to provide for that in the financials. We have to effectively write that loan value down and record it as an expense. Then fast forward 6 months, they're now reducing some of those provisions because things weren't as bad as were expected. So it also makes those financials a bit hard to read, doesn't it? It's kind of hard to put a line through the operating performance of a business when these big, chunky movements both ways are kind of provided for and then written back. It's hard to kind of draw a straight line through the financials.
Well, yeah, absolutely. That's why I'm a little bit hesitant just to look at that March quarter and say, hey, everything's improving. Look, it certainly was improving in up to the end of March. Just to you mentioned loan impairments. The 24% increase in that March quarter was brought about by lower loan impairment expenses. And the bank is saying that because they see an improved economic outlook. So with that said, the bank says they're still being cautious with those provisions and they remain still at very strong levels. So you think a bank as large as this, they're going to have hopefully the best people to try to work this out and just manage those impairments as best they can. But they've actually reduced slightly from 6.8 billion down to 6.5 billion, which is only a drop in the ocean, of course, in terms of its overall lending. But we just got to keep an eye on those.
Yeah, nice. Mate, the other thing I want to talk about is you mentioned the changes to the bank, simplifying the bank's business model. If you'd asked me to forecast, and you may have a different view, right? Which is why I'm asking the question. If you'd asked me to look at those three business units, wealth management, retail banking or traditional banking, not just retail, but retail commercial banking, and then insurance, and you'd ask me to rank the probability of long-term growth for each of those or the size of the long-term growth for each of those, I think I probably would have put wealth management one, probably insurance second, I think, and then traditional banking third. I'm a bit skeptical. I mean, it's not just CBA; all the banks are doing it, but I'm a bit skeptical of the way these banks are happily jettisoning some of these businesses. They feel like, I mean, I know they're doing it for they want to raise capital. I get there's reasons for doing this stuff, but it kind of feels to me like they're getting rid of the family crown jewels, and kind of what they're left with is pretty mediocre businesses, at least in terms of long-term growth potential. Do you agree, or do you think I'm off the mark?
Well, I think, look, you've got to go back to the late 90s when the Commonwealth Bank and all the other banks as well, they moved into wealth management. And I remember there was a national bank, they bought MLC, and the Commonwealth Bank bought Colonial, and it's been a 20-year experiment, really. I think they've tried their best to make it work. We've had the Royal Commission in 2018, which saw all the conflicts between banking and wealth management, superannuation, funds management. So that's been there as well. And so I guess that was a bit of a catalyst for them to moving out of those sectors. I think. I can only guess, but I think even if we go back before the Royal Commission, you've really got lackluster performance, I think, from a lot of these purchase businesses from the late 90s. And look, I think they had the highest hopes, and it makes sense on paper that they could actually make this work. But also remember Suncorp back in the late 90s as well. They were positioning themselves as an all finance company, so that you would just
bank
go
assurance,
to one place.
They used to call it.
Yeah, bank assurance, all finance, whichever way you want to call it. But you'd go there for your banking, you'd pick up some insurance, you'd buy a funds management product for your kids. And on it goes, but it just hasn't worked out. So that's what we're seeing now. National Bank is moving out of, or has moved out of MLC, and we've got the Commonwealth Bank doing the same here with their funds management and also, as I said, the insurance side of things. So we're stuck with banking.
Before before we move on to me asking you for the pros and cons, which we'll do in just a second, one last question or maybe a statement to get a response from, whichever way I end up phrasing this one. So you mentioned the bank's business units or divisions. It strikes me that if you were going to put some kind of key drivers down, the driver of the residential or the what do they call it, the personal banking business is largely going to be house prices, right? Plus or minus a little bit for credit cards. If you look at the commercial business loans, which is probably business health, business investment, wrap that up. That's probably going to determine how much businesses continue to borrow. Institutional banking is a bit all over the place because it's quite a hodgepodge of things, including some proprietary trading, a whole lot of stuff. And New Zealand is then a combination of all three. But if I bring you back to just that personal banking and the commercial banking businesses, am I right? Are they the key drivers? And how do you see the outlook for both of those drivers in those two businesses?
Well, you're right. They're actually the key because the retail banking and the business banking part of it is the main driver. So we've got, as I say, 57% of the whole bank being retail banking, with another third on top of that being business and private banking. And it's just funny that you mentioned those. The performance of those two segments within the business have done really well just in that last quarter. I just wanted to just make it a point that we're not going to judge the Commonwealth Bank or any other company just on 3 months worth of results, but they have been growing very quickly. Now, it's funny to see that the banks actually like to, I suppose, talk about how they are performing against the system, so against the industry, I guess. And they're saying that a home lending, for example, has increased by 5.3%, and that's up quite nicely from the average quarterly performance in the first half. But there's been an improvement in business lending, which is 3x the system. That equates to 8%. And then you've got this is quite a big number, a 13.9 or 14% increase in household deposits, but yet it's only 1.4 times system. So I think you can see that there's a lot of people just generally in the economy wanting to stash money away into banks, despite interest rates being well below 1% at the moment. So that's really important, though, for the Commonwealth Bank, because digging into it, you can see that the source of their funding, or at least 3/4 of it, comes from household deposits. So to see growth like that at 13.9% is fantastic for the bank.
It's a huge
whether
advantage,
it's sustainable,
right?
it's massive. And I think coming back, well, we'll get into the pros and the cons in a minute, but just the size of the bank and its well-known brands, I think, are a big factor in people just flocking to the Commonwealth Bank. They just perceive it as being maybe the safest place to be for their savings.
There you go. So you started the pros. You started to talk about size and brands. If you were going to recommend an investment in Commonwealth Bank, or just try and make the bull case. Now, for those of the uninitiated, the bull cases bull cases are all about positivity and why things might go up. Bear cases, bear markets, they're the downside. So let's start with the bull case. The upside, the pros, the reasons for possibly investing in the Commonwealth Bank. If you were to put together a précis and say, if you're looking to invest in the CBA, here's the top 3 or 4 reasons you would go and put your money to work in Commonwealth Bank shares, what would they be?
Well, okay, I mentioned the brand. So it does have a fantastic brand. There's fantastic recall by the average person in the street. Do you know the Commonwealth Bank? I'd say that the vast majority, probably 99.9% of the population, adult population, would know about the Commonwealth Bank. Which bank exactly? The other thing too is I've mentioned there's been strong improvements in impaired assets recently, so that's good if it continues. We still have a remarkably strong economy despite everything that's going on with lockdowns in New South Wales and Victoria, and maybe again in Queensland. I don't want to preempt anything there if we can help it.
Fingers crossed, mate. Yeah.
I mentioned it's simplifying itself, so it's got its insurance business, so it's becoming a simpler company. And of course, the big one is that it's got a dominant market position. So you can say that about all of the 4 banks, but between the 4 of them, amongst the 4 of them, you've got an oligopoly, basically, that I would say is there's not going to be any consolidation in that 4. That's not going to be allowed by the government. But the market positions of the Commonwealth Bank and the others are so strong that I can't see any material or meaningful, I suppose, change that could affect the bank. But lastly, too, it's the size of the bank. I mentioned it's a $175 billion market cap or thereabouts, and it's just the scale. So when you're talking about something as big as this, you've got really low funding costs. That should mean a stronger competitive advantage, certainly versus a lot of the smaller and regional banks in the country as well. And sure, we've got these neo banks on the side, but they're actually finding that it's quite difficult to compete. You had what was that bank recently? The neo bank, Zinja.
Yeah.
It launched a deposit product without a way of making money, which is obviously through loans. But look, there are going to be competitors that are going to do well and probably just nip at the heels of the Commonwealth Bank. But I think its position does look very strong.
Very nice
competitively
one.
speaking.
Nice one. Well done. So those are the pros. If you're going to try and talk someone out of an investment in Commonwealth Bank, what would you highlight?
Oh, geez, there has to be a few cons, don't they? Yeah, look, I think just despite the March quarter, I still think credit growth is still going to remain a bit of a challenge for the Commonwealth Bank and maybe for just the banking sector in general. So that's notwithstanding that recent good March quarter. So there's a risk that this recent performance could just remain a blip on a long-term, quite a flat trend. Look, the biggest con is, before I get to the biggest one, I'll also say there's regulatory caps on how it uses its capital. So look, this is a good thing and a maybe a not so good thing. I'll just talk quickly about the capital adequacy. The Australian Prudential Regulation Authority basically wants to ensure that banks have enough capital to absorb losses and remain liquid, right? So you just don't want to put your money into a bank and find it's disappearing. We've got an Australian government guarantee on deposits of $250,000 per account holder per bank. So there's that as well. But there's this ratio where APRA wants banks' capital against its assets to be at a certain level. So there is a minimum standard around 8%. APRA, the Australian Prudential Regulation Authority, has an unquestionably strong benchmark at around 10.5%, but the CBA's ratio sits at 12.7%. So it's certainly very strong. Would you say it's strong? I think it would be, but that just means that there's more capital there that has to be kept aside and can't be lent out at higher returns. So
that's the hard part,
think
right? Every dollar kept aside you can't get a return on. So it makes them strong, which makes them more attractive, but also means if you're doing the straight maths, you simply can't put that money to work, which limits the growth, limits the return you can get on that capital.
Absolutely. And look, it is a safe bank. Certainly if you're a depositor, absolutely, there's no concern there. As a shareholder, I don't think you're going to see 100% loss in your investment. That's not going to be the problem. But I think overall, you've got to just consider the biggest thing going against it right now is just simply the price. I've tried to look at the Commonwealth Bank shares in a number of different ways. Just on a PE basis, it's well above the other banks and well above where the CBA has been historically. I can understand that. There's a lot of people chasing yield despite the cuts to the dividend recently. And of course, I like to look at price to book value. The book value of a bank is quite easy because everything is actually it's got to have a price on it. So there's a very easy way to evaluate what the value of all those loans and deposits are. And the price to book is actually, look, even on a conservative measure, it's around 2.3 times. And I would love to buy a share in the Commonwealth Bank if it was around 1.5. So you're looking at, dare I say, maybe around. I'd love to see a discount of around 40% on the current shares. But I just think, given the fairly anemic growth, despite what happened in March, I just think for the price you're paying, there's better value elsewhere. So, which is why I haven't personally recommended the Commonwealth Bank at this point.
Perfect. Now let's wrap it all up, mate. So you've given us the pros, you've given us the cons, and we should say, as you rightly already pointed out, that we're not going to make formal bias or recommendations here. That's kept for our premium members who pay us for our advice, and we want to respect their money and their business. So we're not going to specifically say whether Commonwealth Bank is a buy or a sell, but I'm going to ask you a similar-ish question, which kind of points in the same direction, which is, if you look out 3 to 5 years, which is generally the Motley Fool's average investment time horizon, go longer if you want, do you think Commonwealth Bank is likely to beat the market from here, given all the pros, given all the cons, given the current price? What do you reckon?
Look, I think it's a fantastic franchise. It's dominant. It's got scale. It's the biggest bank in the country. Its growth is not it's not fast enough or high enough to justify the current price. So I think to answer that question, I would think at best it could actually probably match the market over the next 3 to 5 years. I can't really see it beating the market though.
There you go. Ed Vesely, thank you for your time on helping us understand whether the Commonwealth Bank can really win from here. The answer might be business-wise, possibly. Share price, maybe not. Mate, thanks for joining us, and I look forward to joining you again next time we have a Motley Fool Stocks in Focus video. We might do a couple of banks, might do a couple of other companies. Look out for maybe a buy now, pay later stock or so in the next little while. In the meantime, until next time, Fool on.
No worries, Fool on.